Hello, everyone. I wanted to introduce everyone to the discussion about uh, leveraging an IP strategy to really drive business value. And today we have with us a preeminent panel of speakers to really discuss what this is and why this isn't so important. First off, we have Sean Collin. Sean is the managing partner of Growth and M&A Partners. This firm focuses on leveraging IP to create the greatest value as companies sell themselves into the market. Second, we have Jason Somma, who's an IP consultant that helps venture funds, corporate innovation groups, and startups leverage their IP to drive business value. And finally, we have Rob Sterne. Rob is the founding and named partner of Sterne, Kessler, Goldstein, and Fox, the preeminent IP boutique firm that specializes in helping early stage companies strategically develop IP assets globally. Sean, can you let us know a little bit more about yourself?
Certainly. So bonjour from France. Right now I'm resident in Toulouse. So of all the places to ride COVID through, the south of France is not a bad place. I'd like to say that I organized that myself, but blessings to my wife for her excellent work at the medical school here and getting a good gig. So I have worked and lived internationally in 5 countries. I have transacted legal matters in 70 countries. And I'm admitted to practice law in 3 countries. I've lectured in 20 countries. So international intellectual property is my thing. In a 30 plus year career, my focus has been very simply helping to strategically put together intellectual property portfolios and then selling the companies, underlying businesses. So I'm a mergers and acquisitions lawyer. I'm a strategic advisor on intellectual property, but I always work in conjunction with a team. So the folks on this call are completely consistent with my usual team. So that's a little bit about me.
Jason, could you introduce yourself, please?
Sure. So I'm Jason Somma, and I'm a registered patent attorney as well as a business consultant based in Pittsburgh, Pennsylvania, where I work with, as Sri mentioned, a number of startups and corporate innovation groups on issues related to mostly portfolio development, technology commercialization, technology transactions, as well as buy and sell side venture financings, ranging from pre-seed rounds all the way up to acquisitions. So my typical work really involves a lot of software and semiconductor heavy industries, but with Sri, I've worked on everything from life sciences and therapeutics all the way up to some of the largest publicly traded companies in the world.
Thank you, Jason. And Rob, could you introduce yourself?
Well, thank you, Sri, and it's great to be here. My name is Rob Sterne, and I am the founder of Sterne Kessler here in Washington, D.C. Excuse me, I'm actually in my office today, and there's no one here. We have about 450 people in the firm, and they're all working from home, primarily in the Washington, D.C. area, and it's in all areas of technology and in all areas of IP law. And we work with colleagues around the globe, particularly in the principal markets of Germany and China, Japan, Brazil, India, the UK, and France. And we put together and implement IP plans that include not only patents, trademarks, copyrights, but also trade secrets. And then we use those to help drive value and to reduce risk with people like Sean and Jason. So it's great to be here.
Thank you, everyone, for introducing yourselves. Sean, we're going to start with you. Can you talk to us about why it is important to have an IP strategy generally?
Absolutely. And intellectual property strategy is critical for many, many areas of business. I would argue for every area of business, but many, many areas of business, intellectual property is the single greatest driver of value. And when I say value, the 3 forms of value. One is the ability to actually create revenue in the company from intellectual property. 2 is the ability to create capital assets, and I'll explain that in a moment, inside a company. And the 3rd is to be in a position where, because of your intellectual property position, you effectively have carved out legally a unique space in global commerce, hopefully global, that allows the company to grow dramatically. And there's plenty of examples of this. So in my view, intellectual property is the fundamental building block of the 21st century for global business.
That makes perfect sense. And can you step us through a little bit more about what you mean by capital assets?
Absolutely. So if you're thinking about a disposition of a company, right? In other words, you've done a lot of work and you're ready to take some money off the table or find a partner to grow the company or potentially sell part of the company because you want some assistance to get to the next level. Any of those situations, capital raising as well. In all those circumstances, people are going to put a valuation on your business. And if you are in a technology space, a brand space, many, many areas of commerce today, you don't have a building that you own necessarily, or assets in the sense of manufacturing equipment necessarily. You don't even necessarily own real estate, right? So without a factory, without real estate, without a building, what are the assets in the balance sheet that you're going to be selling? And the reality is it's largely going to be intellectual property. I will say that even given the strength of intellectual property on balance sheets, if you look today at the average balance sheet of publicly traded companies and how their capital value is accounted for, much of it is intellectual property. It's in the form, because of the way it's accounted for, it's in the form of goodwill on the balance sheet, which is a difference between the assets they can point to and the valuation the company's been given. So many of those cases, we're talking about the greatest single recorded assets being intellectual property.
And I think everyone understands that at a philosophical level, everyone agrees with that, I think. But from what I've seen with Jason and working with Rob at a law firm, the pushback we often get from clients is, I understand all of that, but it's expensive and it's time consuming and I want to just get the cheapest thing on because I have to go execute. So can you tell us some real world examples of where the IP of a company has really changed the business value at an exit transaction?
Absolutely. So that is in fact what I do as a career is to work with corporations and colleagues like this to actually put together a comprehensive IP strategy. And we'll talk about what that means in a second to create those capital assets or to raise the value of those capital assets. And then I negotiate the transaction to actually realize the check, as it were, or really it's more likely a wire these days. Hopefully it's large enough you don't want to check. And so the way that works as a practical matter in some recent transactions, I personally am working as part of teams globally, but I myself personally only do a couple of transactions a year just because I want to do a really great job. And that's all I really have bandwidth for, to do it thoroughly. And so if I look back over the last 4 years at the 6 M&A transactions that I've been in the middle of, 4 of them have been based in Europe and 2 of them have been based in the United States. And in each of those cases, the multiples on EBITDA that we've been able to achieve are dramatically higher than the industry norms. And so if you look at from a venture capital, you're an angel investor, but from the point of view of angel investors, venture capitalists, investment bankers, right? A lot of the valuations are driven around EBITDA. A lot of IP-based companies may not be in a position to realize the highest EBITDA before they were to dispose of the company. So if you were comparing apples to apples and saying intellectual property-based company is like a building supply company, and therefore you need to get your revenue to a certain point before I will pay you decently, that really wouldn't be reflective of the market. So one transaction I did recently was in the consumer space, but it was a pure IP deal in the sense it was a leading brand. The client owned the formulation, unique formulations, highly scientific, incredibly popular global brand, incredible amount of space to go into the future, right? We did a 42 times EBITDA on that deal. And it was almost 100% IP, because if you're talking 42 times EBITDA, you don't have a lot of revenue to generate the benefit of that sale, right? So in that case, it was a very significant win for the client. And I will tell you, the public company that acquired my privately held, relatively small client, through COVID has been thrilled with the transaction. I mean, absolutely thrilled. So it's not a question of 42 times EBITDA being a ripoff for the buyer or pushing the buyer. In fact, that's a good example of a win-win, right? Because my client did do the work to generate the capital asset base, the IP asset base that is globally booming, hugely successful, right? Massive market growth, et cetera, which is exactly what the public company that acquired them wanted. But at the same time, arguably, that was a cheap purchase for the buyer at 40 times EBITDA, because if you look at their brands, and they have to remain nameless, but if you look at their other brands, through COVID, they've not been as successful. This has been off the chart successful, right? It's the last 3 years. So there's a great example of a win-win. And another example is one where I work for a publicly traded company in the chip space. It's a very well-known company. We're in the middle of a transaction now where we're in the many billions upon billions of dollars. And in that case, my role has been working with the company because of scale every single month to make the changes inside the company to when we go to transact, we're going to get a significant increase from the last investment, last purchase. And we're working through that right now. It's based in Europe. And if successful, we'll see a 25% increase in valuation over 3 years purely because of the IP play and the results of that. So really it is all about, in certain spaces, the way you position the intellectual property and the effect that has on a future market that drives those valuations.
And the IP value is, as I'm hearing you, the IP value is really driving a significant piece of the business value at acquisition. And so that is great to hear. And Rob, I'm going to jump to you because that's great at exit, but I also know, having worked with Rob, that there's a lot of value that can be developed for a company while a company is still executing on its IP. And for example, licensing its current IP. And Rob, I know you were talking a lot about that before.
Yeah, Shri. I mean, the important thing to realize is that there are capital raises that have to be attended to, and people like Sean and Jason have to guide those capital raises. And if the intellectual property plan and execution are done well, you get a higher value and less dilution for each capital raise. And it's not just based on the patent rights or patent assets and the patent assets could be in the form of applications or issued patents. So it's important to have a comprehensive plan, not only for your base country where you're operating, but in your expansion markets and also in terms of your competitor markets, because it's not just an upside, but it's also a risk avoidance mechanism. So the thing is, it's going back to Sean's comment about it being global. Every company should be thinking global, even if they're not operating global. And they need to be able to explain their story effectively to the people that are going to be the investors in the next capital raise. So this is an ongoing focus. It's not something you do when you need to go raise capital. As Sean said, you've got to be doing it on a continuous basis. And you have to be able to convince your shareholders and your management that the investment in this program is probably the shrewdest investment that they can make. Therefore, the plan has to be optimal and it has to be executed optimally.
And that makes perfect sense. And that's a great transition to Jason. You and I have worked with venture capital firms, angel funds, corporate innovation groups, really about how IP strategy is so important. So I want to talk to you about it from an investor's perspective. When looking at a new company, how important is the IP strategy or the potential IP strategy in making that type of decision?
It can be critically important, especially depending upon what industry you're in, what kind of products you're building. And so that's why it's really important. And Rob alluded to this, the business strategy, your intellectual property strategy, and your research and development strategy really need to all fit together and work together. And the business strategy for your company really needs to drive the decisions that you're making related to intellectual property rights. But from an investment perspective, it's interesting because there's been a fair amount of academic research in this space. And one study found that there's a 60% increase in the probability of raising venture capital financing once startups have their first granted patent application. So it's not just us saying this for people who work in this space actively, but there's real concrete data that's out there that shows it. And it's interesting because patents and grants in particular are particularly beneficial at the earliest stages of startups, when a lot of times venture capitalists may be pushing back on making investments into strong patent rights, partly because it's a validation that the technology actually has some sort of novelty or non-obviousness or inventive step to the technology that's being developed. But it also allows for less asymmetry of information. It protects those startups from their from issues related to disclosure, that they don't necessarily have to go and try to get non-compete agreements, which Sri, is you're very well familiar. Venture capitalists are loath to sign and won't do at all. So when you need to build a strategy that really aligns with the way that you're trying to build your company. And in certain industries, your patent rights are going to be quintessential to developing the business. If you're building and developing a new therapeutic or new medical device or another kind of physical product, if you don't have patent rights, it's either going to sink your business or it's going to substantially devalue the work that you're doing.
And that makes perfect sense. And so now, everyone, I think, agrees that it is important to have an IP strategy. I think one of the big questions now, and Jason, I'm going to turn to you about this, is, okay, I understand that an IP strategy is important, but what do you mean by an IP strategy? What is a comprehensive, cohesive IP strategy?
Well, and Sri, I think the biggest point that everybody should take away is that the business strategy of your company needs to drive the intellectual property strategy. And it needs to be something that's informed by, again, your research and development plans, as well as your competent counsel. And you couldn't do much better than having Rob if you need someone on that space. But it's important that you look across all forms of intellectual property and really understand how each one of those fits into the business strategy that you have. So your trademark rights, your brand image, the rights of publicity, patents and trade secrets, publication strategies, as well as copyrights and in the software space, open source licensing. So trying to understand where each of these things fit into your product roadmap, where they fit into the way that you interact with your customers, where your competitors are sitting, from a competitive perspective as well as a geographic perspective, because as Rob mentioned earlier, patent rights, intellectual property rights are geographically limited, and you need to understand where you're going to drive the best value from the work that you're doing, and where you can either need to assert your rights against your competition, or to be able to protect yourself from your competitors suing you or trying to stop you from practicing your rights or selling your products.
No, that makes perfect sense. And I think one of the big pushbacks we get from a lot of companies when we're working with them is, okay, I have 5 patents, I have a good IP strategy. Can you talk to us a little bit about what is an IP strategy? I know, we all know it's a little bit more than just the number of patents you have. Can you talk to us a little bit about, both in the patent and trade secret world, what does a comprehensive, cohesive IP strategy look like? And then going broadly out from that into trademarks, branding, publicity, influencers, how do all of those pieces, marketing, sales, work as part of a comprehensive IP strategy?
Well, the way that I like to think about it is it really needs to be tied to your product and business roadmap, and where that happens along the continuum. Each one of those things can be a critical aspect of developing a comprehensive intellectual property strategy. So from the day where you're working in your garage and you've developed your new and novel technology, it's engaging patent counsel and being able to understand what do you have that is protectable, where you're looking to go with your product, where your competitors are, and understanding what kind of patent applications do I need to file, what do I want to hold back that holds substantial business value by staying secret, and what can I keep secret and not disclose, and what's going to be difficult to reverse engineer along that pathway. And building that early, because again, as we've mentioned before, it can be critically important for both fundraising to have that validation of having a granted patent, but it's also critical that before you disclose, before you make a first offer to sell, that you have applications on file so that you have an effective filing date in order to protect your rights in the future. But as you move forward, you then start to build source recognition from your customers, and that's when your trademark rights are going to start coming into play. You want to make sure that you've cleared and you have the rights to use the marks that you want to use. If you're building software, you're using copyrighted materials in your product, understanding that you have clearance, that you're adhering to those open source requirements from the licenses, the components that you're building into your products is also critically important, but can also be an offensive mechanism because you can use those open source licenses in a way that allow you to maintain and still hold patent rights in order to protect yourself if and when someone uses your licensed technology without permission. And then getting further down the line, you start to see really strong market acceptance of your products. Things like rights of publicity, using celebrity endorsements as part of your comprehensive strategy can be critically important to drive brand awareness, as well as to really to drive your sales and marketability to the point where you're starting to achieve the sorts of revenue multiples or EBITDA multiples on your financings or ultimately your exits in your company, to the point that you then have really delivered on your promise of using your intellectual property strategy to buttress and support the enterprise value of your company.
No, and that makes perfect sense. And Sean, I wanted to jump over to you here. And we were talking about this kind of before the session started, about some of the other ways in which creating an IP strategy, especially early on, well before the exit transaction happens, can really drive up that value. You talked to us initially about why it's important, but can you talk to us a little bit about more in detail where you've seen a strategy like that either succeed or fail in actually creating the comprehensive nature of a strategy?
Yeah, I think that was a great lead, and I had to put my hand up there, Sri, because I wanted to talk about exactly that. So I'm hopefully, cross fingers, closing a transaction I've been on for about 18 months, this month or next. And it's a great example of what has just been explained, which is this client did get good counsel, competent counsel early on. It's about a 20-year-old client, so it's not a startup in the traditional sense of, grow quick, sell quick. It's one could argue they're a contract manufacturer. And for those who are in the M&A space, you all know that a contract manufacturer at best is going to get about a 3 times EBITDA multiple. Soaking wet if you're very lucky, right? It's very hard to get a good multiple on a pure service business, no real IP. And the reason I wanted to take on this matter is because it was a friend of mine referred him to me from another deal. And they said, no, Sean, there's something else here. You got to look at it. And when we got in and looked at it, what they've done is exactly what's been spoken about, which is the owner of the company early on said, hey, our expertise really is in formulations. Our expertise is in the chemistry of this. Our expertise is in nutrition. It's a nutritional company. So effectively, where we are 20 years later is that a contract manufacturer, because of the way they handle their trade secret portfolio and their patent filings very strategically around it, own the products, in every sense of the word, for some of the biggest brands out there. I mean, if I told you all the brands that they control, right? They own the formulations. They have contracts that mean that parties cannot go out to a third party and get them manufactured. I mean, it's really, really well done. And with some additional work over the last 18 months to shore things up, we went from a valuation as a contract manufacturer to a valuation as an IP-based licensing company, right? Which is in the 9 to 14, maybe even 16 times valuation range. So EBITDA. So there's the best example to follow up, right? Which is, here you have a company that's in one category of business, because they handled the balance of their IP so thoroughly, so well by contract, so well by what they protect as a trade secret versus what they protect with patents, right? Because obviously they didn't want anybody to know with chemical formulations, they could keep it confidential, keep it tight. So it was beneficial. Their time to market is a fraction of their other times to market of their competitors because they own their IP. So everything about this business is positioned very dramatically for growth with a great partner, which I was engaged to go help them find, which we found. And it's a great story. The best I can give you is very simple. Without the strategy that's just been described 3 times, right? With the strategy, because the company is still in growth, 9 to 11 times. Next phase of sale, I'm 14 to 16 times. I really think so. So you're effectively changing the industry in which you're being categorized from a valuation standpoint, premised on your IP strategy and portfolio. So that's probably the best example I have.
No, and that makes perfect sense. And Rob, I wanted to jump to you because you were just talking about the global nature of IP. And as Jason was talking about having a comprehensive and cohesive strategy, we were talking about the different types of IP, but you also have to leverage the different geographies you're going to be going into. So I wanted to ask you a little bit about how does one think about creating an IP strategy in a global sense?
Well, you have to recognize that we're in a global marketplace today. And gone are the days where the United States market was the center of the universe and was much, much larger than other markets. For example, BBC recently reported that the number one trading partner for Germany has shifted from the United States to China. So the emergence of the Chinese economy and the improvement that they have made to their IP system, which is incredible and dramatic and comprehensive, has produced a inflection point in terms of global IP strategy. That coupled with Brexit and the emergence of other major markets such as India and Brazil makes it imperative that companies think globally for 2 reasons. Number one, that's where their expansion could be coming from. And number two, that's where their competition could be coming from. And therefore, if you're an investor, you want to know what has been done in terms of your IP portfolio and strategy in terms of your upside potential. The ways to add value from IP, which come in many, many different forms, not just licensing revenue, but freedom to operate and things like that. And also basically locking in your employees and also working with in joint ventures and things like that. So those things are very important, and that requires really good agreement lawyers like Sean and Jason to make sure that the agreements are in place and that they're doing what people think they should do or supposing they should do. But the other important thing is downside risk. And if you are a small company, if you have a strong IP portfolio and you get approached by a big company that's trying to shake you down or push you out of that market, you're in a position to cross license and leverage your IP portfolio against them, because oftentimes these big companies have not done a good job with their IP, and therefore it's like David and Goliath, and you can use your IP portfolio for freedom to operate and for very critical downside risks.
And so building on that, I really want to take, okay, so now in this David versus Goliath or this IP strategy, a lot of corporate counsel say, okay, I've got the good IP strategy in place. I know what I want to do. How important is it to bring in a strong team of IP specialists in order to execute on this strategy?
Well, it's paramount. And the reason it is paramount is because the amount of change that is occurring in patent systems around the globe, for example, or even in trademarks or copyrights or trade secrets, is huge. And it takes many, many hours, tens of thousands of hours, frankly, and good infrastructure to support an attorney or a professional who is competent to obtain maximum IP rights. I mean, your IP rights can be much worse than the underlying technology and innovation or brand. So you need to have experts. The analogy I always use is that of a world-class orchestra. In a world-class orchestra, you have many different instruments that are manned by skilled musicians that spend their whole life mastering that, not just the music that they're playing, but their instrument. But you have a conductor, someone like Sean or Jason or myself or you, Shri, that has to conduct that group of IP professionals. And basically, you could analogize the different instruments to IP professionals in all the major geographical jurisdictions. So if you would imagine, you can have the best musicians and still have a terrible performance, or you can have a world-class conductor, but the musicians are terrible, or they don't work together, or the conductor can't work with them, and you still have a terrible performance. So everything has to go right. And my view is you have to have two types of people. You have to have the specialists, what I call the subcontractors, maybe, if you use a house analogy. And then you need a general contractor or the conductor. And that's the person that makes sure the whole project comes together the way you want it to come together.
And even if I understand, I'm going to go with this orchestra analogy for a second. Even having the person with the best skills may not make it the best trumpet player, because there's also a knowledge of having to listen to what the rest of the orchestra is playing to know how to play your instrument as a part of that team. Does that analogy work in the way that I'm thinking?
Totally so. And that brings up a very important point. Let's take the issue of validity of a patent based on prior art and based on claim construction as applied to prior art and based on what happened in the prosecution to obtain those rights in those various jurisdictions. If a challenge is made to the validity of those rights, which happens a lot, and many venture capitalists and investors find that surprising, that the IP rights can be taken away, that they're assuming are forever or for a fixed term. But in fact, that's not true. The courts or the administrative agencies like the patent offices around the globe have mechanisms that can be employed to take away the rights prematurely. So if there is not full coordination between the various team members when such a validity attack is mounted, and I'm involved in many of these, what ends up happening is you make a mistake in one jurisdiction in terms of the positions you take or the arguments you make or whatever you do, and that ripples through the entire portfolio of rights and basically can have a domino effect that can have unbelievably negative consequences to rights that should otherwise have been very secure and protectable.
And so, Jason, I'm going to pick on you for a second because you and I are both investors in early stage companies. How important is getting the right patent, the right disclosure, the right trade secrets policies and procedures in place, the right trademark strategy, culture strategy, in view of making investments, as opposed to just having a strategy?
So I will say that it depends on what kind of company you have and what stage you're at. And because again, like in the life sciences, you have a lot of very sophisticated investors who really understand the quality and importance of intellectual property rights. And I think in a lot of physical technologies, you do as well. I think what you see in software and a lot of digital technologies is that the early stage investors really, they care about growth, they care about traction. And then all of a sudden you get to the point later down the line with your Series B, C, D investors, as well as your exits, where all of a sudden they have a little bit more money on the table. They're bringing in their counsel. They're starting to look through your IP rights. And all these things that you thought weren't necessarily important in your first year or so of developing your company become critically important. So I was working with a company over the last year or so where all of a sudden their later stage investors looked at their intellectual property portfolio and realized it was wholly inadequate. It was missing critical components other technology that they were going to need to be able to license or ultimately drive an exit. And they went and called their patent counsel and gave them massive bonuses just to be able to get quickly issued patents, where what they really should have been doing is they should have been spending probably about a third of that money 3, 4, 5 years earlier to develop really strong IP rights, as opposed to this broad spray of patent applications around the world that ultimately aren't going to hold up the second that someone comes and tries to validate that portfolio. So I would say that even if your investors don't think it's important, especially early stage investors right now, you need to be critically thinking about who's going to be out there to acquire you, who are your competitors, and what's going to happen in 2 to 3 years when your revenues go from 100,000 to 500 million, and you have a giant target on your back.
And Sean, building up on that idea, I know, prior to this call starting, you were talking about the difference between coming in 6 months before an exit transaction is going to happen and having a limited time frame in which to fix things, and coming in 18 months and being able to bring in the proper team to really build up that portfolio value so that the exit really substantially changed. Can you tell us a little bit more about that?
Yeah, and I think the best way to explain it is kind of in the negative first, which is 32 years ago when I was in Sydney, Australia, working for a law firm as a baby associate called Mallisons. Now it's King Woods Mallisons, mega firm right at the time. And I was in my first week, and I was in the M&A group, and I was all excited, and they asked us, they lined up 7 first-year associates, and they'd say, okay, who's done securities law? And they'd put your hand up, and okay, your job is to go in that conference room and look at this, right? Who's done IP? And I was the only one that said I did IP, right? So they said, okay, your job is to go in that conference room. It's full of boxes, and figure out what the seller doesn't have. I go, yes, sir. And I had my suit and my briefcase, and I walk in that room, and it was a sea of boxes, right? And I'm thinking to myself, I'd written down, figure out what the seller doesn't have, and I remember seeing the chairs before the internet, right? And looking around going, how the heck am I going to figure out what they don't have, right? But that was the point of value globally, which what, my colleagues have been talking about. How much had been put in place globally, and what my boss was really poignant about was, Sean, we're going to drive the purchase price down. We represent the buyer, right? So you figure out what assets, IP assets that are needed to run this business in which jurisdictions, and what they don't have to do that. And that's going to be a gap analysis. And from that gap analysis, I'm going to walk in that room and I'm going to hammer those guys and drop that purchase price, which is exactly what we did. So there's the flip side to answer the question, right? Is it's, you can look at, if you're acting for the buyer, which I was, it's very simple. You figure out a gap analysis, you figure out what isn't there, what should be there to drive the business forward. And there's your reduction in value. So I now, and since then, have always done exactly the opposite. As I look at, you give me 18 months versus 6 months, I'll hopefully do a better job. I certainly will endeavor to do so, but I do exactly the same thing. I sit down with the client, sit down with the business people. Where's the business now? Where's the growth opportunities? Where's the business going to go? What are the categories of buyers? Are they global? Are they domestic? Where are they going to go? And based on that gap analysis, which literally I do in a spreadsheet by country and by sector, it's very methodical. Same plan, 32 years, right? Figure out where the gaps are, and we run hard to close them. Now, the point that my colleagues have been making, can you always do that, gentlemen? No, right? I mean, sometimes it's too late. Sometimes you just can't, because patents are fairly complex things, and you may have some prosecution with drop dead dates that are drop dead, which means no, you have no more rights you can get. That's it. Good example, I was approached on behalf of one of my clients. I was looking on the buy side, and I was approached by a company out of Germany, and they have a terrific innovation. Really, really excellent. Went through the engineers of the client, love it, fantastic. There was a bankruptcy, there was a huda hada hita, there was a this, that, all they have, right, is a patent in Germany and it's a global market. Is my client going to pay him anything other than the cost of their prosecution for that? No, because it's public domain, right? Effectively, everywhere in the world, right? People can practice it. So what have they got? The answer is Germany. And if they'd have done it right, Cherie, if they'd have done it and not had those bar dates, and there's everybody on the call except for me is more expert in this than I probably, but if they had done the patent prosecution correctly, the value would have been there globally, which was lost. So hopefully it answered the question.
That's perfect. And we're coming close to the end of time. So before we open this up for questions, I wanted to just ask each of you to give final thoughts on the topic of leveraging an IP strategy to drive business value. The importance, what should our audience really be thinking of as they leave this talk? I'll start with you, Sean.
I think you have to analyze the industry you're in, where it's going, and where your company can be most favorably positioned, not only today, but tomorrow and the next day, and come up with where you believe your company should be in that process and when, and then allocate the resources accordingly. And what I mean by that is the type of intellectual property, the countries involved, a thought process around growth. It's not enough to be static. It's not enough to look at what your business is now. You have to look at it from the point of view of a prospective buyer, right? Who's likely to be your buyer? What jurisdictions do they want you to be in? And how do you get there as effectively as you can? And that's the minimum.
That makes perfect sense. Final thoughts, Jason?
Your business strategy needs to drive your IP strategy, and your IP strategy needs to inform your business strategy. And I think that all the points that Sean just made really buttress that overarching idea, because if you build an IP strategy that's divorced from your business strategy, you're not going to be able to develop the kind of value from your intellectual property portfolio that you should be able to. But if you build a business strategy that doesn't have a well thought out IP strategy that supports that business strategy, all of a sudden down the line, you're going to lose massive amounts of value, or possibly even be precluded from building the products that you're looking to build.
No, that makes perfect sense. And closing thoughts, Rob?
Yeah, and so how do you do this? Because I agree with my other speakers completely. You need a virtual or a part-time chief intellectual property officer. This is the individual, this is the Sean or the Jason or the Rob or the Shri that coordinates everything, implements, makes sure that the plan is implemented effectively and promptly and efficiently and optimally, lots of words, but it requires a person who's acting like a general contractor, who's looking out first and foremost for the best interest of the client, because by doing that, you produce the maximum value and you reduce the risk as much as you can. And that's where the real value comes from. And then once you have that, then people who can explain it to the investors and basically sell it to the investors like Sean and Jason and you have the story to tell.
No, that makes perfect sense. And I'm going to close up with that general contractor thought, meaning the general contractor does not have to be an expert electrician or an expert plumber or an expert carpenter, but the general contractor has to know what all of those pieces are going to do together to make the house a home. And in view of that, that's really what your in-house chief IP counsel really has to do, is know how to use all the tools that they have available to get the best results done. I thank everyone for listening to us. I thank our panelists for being here to talk to us. We're going to be opening this up to questions shortly. Thank you very much, everyone.